Welcome back. So in this video we're going to do a very simple cash flow statement. Now remember, cash flow statements are different than the income and balance sheets because we're looking at accrual accounting. Okay? So accrual accounting means, as a reminder, if you have like an accounts receivable, that means you're waiting for someone to pay you, that's fine. And an income and balance statement, you act like you've already received that money. Whereas an accounts payable, even if you haven't actually paid it, you act like you've already paid it. That's accrual accounting. But the cash flow statement actually measures monies that have come in and gone out. Okay? There's a lot of firms that go bankrupt because of the fact that their income sheet and their balance statement looks great, their balance sheet and income statement looks great, but they actually don't have any real cash coming and going, therefore they can't pay debts, creditors, etc., etc. Okay? So this is important. So you should already have your net income. So you start with a net income of $1,000, just as an example. And everything that I've got in here in blue is something that you're adding, and everything I've got in here in purple is something you're taking away. Okay? So depreciation amortization is an addition of 50. And you're thinking, wait a second, didn't you already teach me that depreciation amortization is a decrease in the value of something? Yes. So on the income statement, the balance sheet, you subtract those things off. But since no cash actually left the firm, you count that as an addition. You've also got a decrease in assets or increase in liabilities that we're going to add. And I know this is counterintuitive, but think about it. Decrease in assets means you've sold something. Let's say you have a factory that sells sweaters or makes sweaters. If you sell $100 worth of sweaters, then that's $100 that you are gaining. That's why it's decrease in assets. An increase in liability means that you're going to owe somebody something, right? But in the meantime, some sort of a service or product has been rendered to you, and therefore it counts on your books as a cash inflow. So I put 100 there. And flip side, an increase in assets. You have bought stuff, like let's say you're making sweaters again, you've bought some wool or something. So that's an increase in assets. Or a decrease in liabilities, in other words, you've paid off debts with cash, and therefore that's a decrease. So you've got your 1,000 here. You're gonna take and add up $50. You're gonna add $100, and you're gonna subtract $50, which gives you a total of 100. Now I've seen some people that use a running tally technique. So instead of saying 100, they'll actually say 1,100. People have different ways of doing things, so I'm just kind of including both here. Then you look at net property and plant equipment. So if you're buying property, you're buying equipment, that kind of stuff, that's going to be a cash outflow, in this case of $200. So we've lost 200, or 1,100 minus 200 is going to give you 900. This also throws people off. Increase in net borrowing. If you take a loan from a bank, that is cash that comes to you. Yeah, you got to pay it back, but in the meantime, that's cash that comes to you. So that's a cash inflow, in this case, of $300. Let's say you want to sell some of your company. You do a stock sale. That's going to give you $400. And of course, if you want to pay the owners back, that's paying dividends, and that's also a cash outflow. And so that gives you, if you add, once again, 300 plus 400 minus 1,000, that's going to give you 600. Or if you want to use a running tally technique, 900 plus 600 is 1,500. And that gives you an increase or decrease in your cash flow of 1,500. This is a very simple one. We'll do a little bit more complicated cash flow statement in the next video. As always, I hope you enjoy this video. Give me a thumbs up, comment down below, and make sure you subscribe. Awesome. I'll see you next time.